Good morning and welcome to our half-yearly investor webinar for the Totus Alpha Strategy. I'm joined here by Tim Warner and Jack Cherry from our investment team. Today's webinar will follow our usual format. I'll start with a quick overview of Totus and a reminder of the objectives and expectations for our Alpha strategy. We'll provide you with some high-level thinking behind our investment process. I'll run through some recent market observations. Tim will give you an update on performance, and then Jack and Tim will present some current themes and stock ideas in the portfolio. And we'll finish with some Q&A at the end. As a reminder, this webinar is being recorded and a link to the replay will be made available after the session. The information provided in this webinar is for general information only and is not intended to provide you with financial advice. It has been prepared without considering your objectives, financial situation, or needs. So Totus Capital is a Sydney-based absolute return investment manager. Our objective is to preserve and compound our investors' capital alongside our own, regardless of conditions in the broader equity market and economy. Our investment team are heavily aligned with a significant proportion of our liquid net wealth invested in the Totus Alpha strategy. We offer a true alternative to traditional equity investments in that we aim to deliver positive risk-adjusted returns in all market environments, regardless of the cycle. Our equity long-short strategy uses themes to concentrate our investment universe and focus our research efforts. Fundamental bottom-up research is then used to identify companies exposed to those themes. The Alpha strategy has an open mandate, and this flexibility allows us to select the investment opportunities across all industry sectors and market capitalizations globally that best fit our themes. Our basic philosophy is that good companies outperform bad companies over time. We believe that alpha or performance can be generated from both sides of the book, long and short, and that fundamental bottom-up research drives alpha. Carrying a diversified book of shorts at all times provides good protection against market risk and market sell-offs. And the ability to invest globally enhances our opportunity set. The net result of this approach has been a strong track record of performance over 12 years, delivered with minimal market risk. Our average net exposure to markets since inception has been only 35% of net assets, and we've had zero beta or correlation to equity markets. The Totus Alpha strategy has made money on average in up markets, but we've been particularly pleased with how the strategy has performed in down markets since inception. This strong performance during down markets helps smooth returns for our investors with long bias portfolios, allowing them to better navigate bouts of market volatility and hopefully hang on. Turning now to our investment process, I think it's worth touching on two key points: why we invest in quality longs and why Australia is a great place to find shorts. As mentioned earlier, we believe good companies outperform bad companies over time. But what is a good company? A simple, quick and easy measure of quality is return on invested capital, or ROIC. Return on invested capital shows how efficiently a company is using shareholders' funds to generate income or earnings. We looked at the 10-year rolling returns over the last 20 years for stocks within the major indices relevant to us and filtered by return on invested capital as a measure of quality. There were three key takeaways. The first is that quality is scarce. There aren't that many high return on invested capital companies. The second was that investing in these high return on invested capital or high ROIC companies increases your odds of success, and it also improves your returns as high return companies perform better over the long term. This is why we focus on quality on the long side of our book. We try to fish where the fish are biting. Turning to shorts, many of you will know that our short book is typically tilted towards the Australian market, where we have a home ground advantage and a live market being based here. Luckily for us, the data also shows that the opportunity set for shorting in Australia is exceptionally good. On average, the hit rate of picking a company that generates a negative total return over a 10-year time frame is much higher in Australia than it is in the USA. Your chances of losing money over 10 years is 42% for the ASX, All Ordinaries Index, and an incredible 51% for the small cap index if you pick a stock at random. Amazingly, the 10-year average return for over half of all small caps in Australia is a loss of over 10% per annum. Tim will now run you through some comments on our recent performance.
Taking a step back and looking at our performance over the long term, the fund has delivered consistent equity plus returns. Year to year, however, the performance will vary, and over the last year, we have delivered an absolute positive return, but underperformed Australian and global equity markets. Now, we try to perform through all market environments. However, during strong risk-on periods, the strategy sometimes has lagged equity markets, as the short book can be an anchor on our returns. Now, it is important to highlight that the fund returns have been delivered with substantially less risk than overall equities, running average net exposures of around 30% over all timeframes, and delivering a return profile with no beta or correlation to the market. In simple terms, the return stream the fund has delivered is truly uncorrelated alpha and has been achieved with minimal market risk. We are always striving to learn and improve our process at Totus. The post-COVID quarter experience taught us a lot about the risks within the strategy and honed our focus on how to improve our risk management. Now, we have implemented a range of improvements, in particular around managing the short portfolio, and that has led to an improved risk profile without limiting the potential to generate returns. This is evident when comparing our 3-year numbers against our since inception numbers. The fund has delivered similar mid-term returns over both time periods with low net exposure and no beta or correlation, but it has done it with substantially less gross exposure and volatility, which overall has led to better risk-adjusted returns for our investors. I'll hand back to Ben to talk through some market observations and insights from our recent research trip.
Last week, we returned from San Francisco, where we attended the Morgan Stanley Tech Conference. It was our 3rd year attending this conference, and as usual, we learnt a lot. Similar to last year, the theme of this year's conference was artificial intelligence, or AI, and every speaker from Elon Musk and Sam Altman down had strong views on the subject. Our take was that unlike crypto and the metaverse in 2022, company management and investors' conviction levels on this AI thematic had only increased over the last 12 months. Given its potential to drive efficiency and improve corporate profit margins, there was a view that AI demand was not constrained by IT budgets if sufficient return on investment could be demonstrated. However, there was an acknowledgement that for many companies, AI will be a cost in 2024, with the hoped for monetization coming in 2025 and beyond. One of the preconditions for AI adoption is migration to the cloud, which should benefit the cloud hyperscalers, Amazon, Microsoft, and Alphabet, which we own. That said, there appears to be a shift in IT spending away from software and into hardware, as well as a greater focus on total cost of ownership for enterprise software. A big focus for investors was the likely use cases for generative AI. Early successes include driving better recommendation engines for Meta and Google, automation of contact center processes by buy now, pay later company Klarna, crunching large amounts of complex data in industries such as healthcare and defense, supply chain and inventory management, and data retrieval for enterprise. Our strong impression was that as the amount of compute increases and the models becomes increasingly sophisticated, the range and complexity of AI use cases will continue to expand. In cybersecurity, AI is contributing to an escalation in the arms race between companies and bad actors. The issue is a major focus for both governments and executive C-suite. This has resulted in a strong regulatory tailwind for the cybersecurity sector. So how are we playing it? Step one has been to exit or materially reduce our short exposure to anything that could be perceived as an AI beneficiary. Booms attract promoters, and while these in time could become a good source of opportunities for our short book, timing is everything, and being too early to bet against a boom of this magnitude is dangerous. On the long side, the obvious beneficiaries of AI are the makers of hardware for data centers, NVIDIA and AMD and TSMC, as well as businesses like Meta, Alphabet, and Microsoft and Amazon that have huge amounts of data and compute, as well as the products that can be improved and better targeted and monetized through the use of AI. Fortunately, the fund was well positioned in Amazon, Microsoft, and Alphabet. However, we regret not initiating a position in NVIDIA and AMD after last year's conference. These dominant tech hardware businesses do seem to have a large first mover advantage, as well as scale and deep competitive moats that we hadn't fully appreciated at the time. That said, they have run very hard recently, with plenty of upside now priced in. There's significant debate around the impact of generative AI on search, which is impacting Alphabet's valuation multiple relative to the other Magnificent Seven at the moment. Alphabet has seen off numerous threats to its monopoly in search over the years, and this time may or may not be different. For now, the business is flying, and the company is using its huge cash flows and balance sheet to buy back stock at attractive prices. We've used the current weakness in Alphabet shares to marginally add to our position. AI requires large amounts of hardware, data, and compute, the cost of which is dictated by energy. In Australia, we have a position in Goodman Group, which is a world leader in Grade A industrial property in Tier 1 cities in Australia, the USA, and Europe. Goodman controls an advantaged land bank with access to power supplies, which is perfect for building data centers. Goodman has a large and growing data center pipeline, and while not cheap versus other listed REITs, Goodman is very cheap relative to other listed data center landlords. On the energy side, AI data centers consume immense amounts of electricity. Demand for AI is sensitive to price or return on investment, so if adoption is to scale, the world is going to need vast amounts of cheap baseload power. Sam Altman from OpenAI thinks the long-term solution to this is nuclear fusion, but solving that isn't going to be easy or quick if history is any guide. Thermal coal remains one of the cheapest and most reliable sources of baseload power, and we have some exposure to it via Whitehaven, New Hope, and Yancoal here in Australia, which also happen to be some of the cheapest stocks on the Australian Stock Exchange. Turning now to the market. We've experienced a strong run for equities and risk assets since October 2023, driven by ongoing economic strength, declining inflation, large fiscal deficits in the USA, which is stimulating demand, and a less hawkish Federal Reserve. In the US, the prospect of a Trump victory in November and continued spending from the Biden camp is also being taken as a positive for markets. Earnings have continued to recover, which has driven stock prices, but we do see some emerging risks. Inflation has been falling, but recent readings have surprised to the upside. Full employment combined with big fiscal stimulus and easing monetary conditions risks overheating the economy and a re-acceleration of inflation, which would make cutting interest rates difficult. At least part of the recent strength or re-rate in asset prices has been due to expectations of interest rate cuts later this year. The other thing is looking big picture, historically the long-term returns for buying stocks when unemployment is low, is very low, are poor. Intuitively, this makes sense given during periods of high unemployment, like 2009, earnings tend to be weak and stocks are on sale. That is certainly not the case now. Sentiment from investors has turned bullish on stocks, and indicators are currently sitting in greed territory. On balance, from a top-down perspective, the markets do seem well supported short term. However, there are some clear risks in the medium to longer term. It's virtually impossible to predict turning points with any consistency. Therefore, we continue to run short positions at all times while being careful about position sizing. Looking at current positioning, we are currently running just above our historical average net exposure of 35%, but continue to run lower than average gross exposure. The increase in our net exposure has come from adding to exposures in high quality businesses and adding cheaper exposures such as metallurgical coal, which have strong long-term tailwinds for demand and constrained supply. I'll now hand over to Tim to talk you through some themes in the book.
Okay, so let's dive into some of these themes in the portfolio. Firstly, within our key structural themes of bricks to clicks, cashless society, online classifieds, and financial asset ticket clippers, our main company exposures are all high quality compounders with long track records of success. Amazon, Visa, Rightmove, and CME Group. Now looking at these charts on the screen, there is a common theme that stands out to us. All of them have long-term EPS growth, but have experienced a significant multiple D rate versus history over the last few years. We think these companies are all primed for continued earnings growth, with certain names like Amazon experiencing acceleration due to increased discipline on costs. Stock prices tend to follow earnings over the long term, and paying a reasonable multiple as your starting point limits the downside risk from a valuation D-rate. They may not be in the headlines as a hot theme like AI currently, but all these companies have structural growth tailwinds with strong economic moats, which we think will continue to compound over time. Now, we have spoken on undersupplied commodities in the past webinars, but we think it's worth updating you all as it is a large active position and can cause short-term volatility to our returns. Our main exposure to this theme is metallurgical coal. Now, met coal is a major input in steel production, and steel is needed for infrastructure in both developed and developing economies, and will be essential for the green transition that governments are mandating globally. Steel, and thus met coal, is correlated with global GDP growth, and thus long-term demand should continue to be healthy. However, the main reason we are constructive is due to the supply dynamic. We believe that met coal, and in particular high-quality met coal, is geologically scarce and has been significantly underinvested in due to regulatory and political concerns, which will lead to structurally higher prices over the long term. The main exporters are concentrated in 3 key jurisdictions: Australia, Canada, and the US. And you can see that supply has been in structural decline in all 3 of these regions since the peaks in the mid-2010s. And despite a significant increase in price, the supply response has been muted versus previous booms. Now, we are invested in this theme through 2 key ways. In Australia, we are invested in Stanmore Resources and Whitehaven Coal, who we believe are creating value by acquiring unloved assets cheaply from non-economically motivated sellers. And in the US, we're invested in several high-quality met coal miners who have been very clear on their capital allocation framework, where all the free cash flow generated is getting returned to shareholders via buybacks and dividends. The whole sector continues to trade extremely cheap, with free cash flow yields ranging from 10 to 20%. We like this theme long term, and we are aware though that commodities are cyclical, and we are prepared to take some of this volatility short term for the potential long-term gain. Moving on to the short side. Now, unfortunately, we have been wrong on the consumer slowing down. Retailer expectations were bearish, results were better than feared, and we were caught wrong-footed. Despite being wrong to date, we believe that the setup now is offering a much more attractive risk-reward. Multiples are full versus history, consensus expectations are for sales growth to re-accelerate, unemployment is starting to tick up, and the consensus on interest rate cuts keeps getting pushed back. We are selectively short companies in this space where we think that they have structurally losing share, and also where we believe margins continue to be elevated versus history. Since the last webinar, our shorts in the price volume unwind theme, in particularly the supermarkets, has worked quite well. But we continue to stay short as we can potentially see signs of history repeating itself. Last time the supermarket share prices were under pressure in a major way was in 2015, after a period of strong gross margin expansion, followed by a change in management at the C-suite, and ultimately competitive pressures across the industry. This time may be different, but we continue to closely monitor the space, especially with more competition from offshore players such as Audi this time round. I'll now pass to Jack to run through some individual stock ideas in more detail.
Thanks for that, Tim. I'll now run through some current positions within the Totus Alpha Fund. Australians are known for their love of travel, and with 3 large-scale travel companies listed on the ASX, it's an industry that we pay quite close attention to. Whilst these companies are considered the best travel-related investment opportunities domestically, our ability to look offshore presents us with an opportunity to invest in what we believe to be the global leader in online travel at an attractive relative valuation. This recent addition to the fund is Booking Holdings, the parent company of Booking.com. Some of you may be familiar with the business, having used its platform to find accommodation in one of its 220 countries in which it operates. With over 28 million properties and 1 billion nights booked on the platform in 2023, Booking.com is the world's leading portal for booking accommodation online. Booking Holdings is a $127 billion business, generating in excess of $5.8 billion in EBIT in calendar year 23, at an attractive 27.3% EBIT margin. Having compounded earnings per share at roughly 12.5% over the last 10 years, including COVID, the business has demonstrated an ability to expand margins, take market share, and return significant levels of excess cash to shareholders along the way. Similar to Flight Centre in Australia, Booking.com generates revenue via a percentage take rate on gross bookings made on its platform. Since 2019, Booking.com has now introduced other travel segments such as flights, car rentals, and insurance in an attempt to create a global one-stop shop online travel agency. Booking.com is part of a long-term trend of bricks to clicks, which is a key theme within the Totus Alpha Fund. This theme tends to reference services and offerings that had traditionally been accessed in person, like attending a Flight Centre store, shifting online to travel agencies like Booking.com. Whilst this theme is maturing over time, we believe that each incremental person that becomes old enough to travel going forward will have a significantly higher propensity to use an online travel agency versus the people aging out of travel. Booking.com is a platform business which experiences network effects. More supply added to the platform attracts more customers, which in turn incentivizes more supply. This flywheel creates a significant competitive advantage for Booking.com, which has been aggregating accommodation listings across the globe for the last 20 years. It is very difficult for new entrants to match Booking on breadth and price. The additions of flights, rental cars, and insurance onto the Booking.com platform is part of a broader push by the company to create a universal travel platform embedded within their mobile app. The emphasis the company places on the mobile app is for good reason. Having been responsible for close to a quarter of gross bookings in 2019, app penetration has surged to over 50% of all bookings in 2023. Now, Booking.com is one of Google's largest customers, with the company spending 30% of revenue on sales and marketing. On the third quarter call, CFO David Goulden revealed that all of our mobile app bookings are in fact direct bookings, meaning the company has low to no customer acquisition costs for app bookings. This shift in booking unit economics is beginning to show itself within the company's financial accounts, with clear evidence of operating leverage over their marketing spend emerging, as shown in the chart on screen now. As app penetration increases, we expect to see continued margin improvement in the business through operating leverage over marketing spend, as well as other fixed costs. Part of our investment process is comparing offshore companies to their Australian peers. In this case, Booking.com versus Flight Centre presented some interesting takeaways. Firstly, on a trailing 12-month basis, Booking.com's asset-light business model produced 27.3% EBIT margins versus 11.3% for Flight Centre. In addition, Booking Holdings shares on issue decreased roughly 8% year on year via extensive buybacks in 2023, whilst Flight Centre's actually increased 9% over the same time period. Booking.com's core business possesses structural tailwinds from both a bricks to clicks perspective, as well as demographic shifts in how travel is booked. A key segment of Flight Centre's business is its brick and mortar stores, which we believe face structural challenges, and any accelerated shift to its online offering only brings it into closer competition with both Booking.com as well as other large-scale online native businesses globally. We believe Booking.com is simply a much higher quality business than Flight Centre, yet trades on the same forward earnings multiple. This presents a prime example of where looking offshore for business models we understand can provide compelling investment opportunities relative to their Australian peers. In addition to travel, online classifieds are a prominent long bucket within the Totus Alpha Fund. These businesses have structural advantages over the long term. Firstly, they require very little capital to grow, which leads to significant free cash flow generation and extensive capital returns to shareholders, depending on management's capital allocation philosophy. Secondly, online classified businesses globally have demonstrated significant pricing power when it comes to their products and services. Hemnet, the dominant number one retail real estate portal in Sweden, was able to increase average revenue per published listing 46.2% in 2023, with listings growth over the same period of 5.3%. This pricing lever is no different in Australia, with realestate.com.au increasing prices by 13% last year. Finally, like Booking.com, network effects play a pivotal role in growing and maintaining dominant market positions for online classified businesses, both locally and offshore. A customer looking to sell their house, car, or hire an employee will be incentivized to use the portal which possesses the largest audience and hence the most market share. Alternatively, someone looking to purchase a house, car, or find a job will visit the website with the largest range of listings. As listings grow, so do customers, and this flywheel continues strengthening market positions as these businesses scale. In contrast to the Australian portals, European classifieds businesses have demonstrated excellent discipline when it comes to capital allocation, returning the vast majority of free cash flow back to shareholders via buybacks and dividends. This capital allocation policy is built on an understanding that they are better to focus on their core, cash-generative business models rather than dilute earnings with lower margin adjacencies, which are unlikely to possess the same competitive advantages and market position that they currently experience. Unfortunately for the Australian peers, this is less true, with the exception to the rule being car sales offshore expansion currently. Ongoing investments into mortgages and India for REA, or Asia and the Growth Fund for SEEK, have so far served only to dilute shareholders' exposure to their best-in-class core operating businesses. As Australians, we are fully aware of the market position owned by realestate.com, car sales, and SEEK. These businesses, due to their dominance, have earned premium multiples in the Australian market. However, leveraging our understanding of these business models offshore, we were able to initiate an investment in Rightmove, the UK's number one real estate portal with 86% market share, at only 21 times earnings, which is less than half the multiple of REA. The chart on screen shows the comparative multiples of these global listed online classified businesses. As you can see, the Australian subset currently trade on higher multiples collectively versus their European counterparts. Yet, interestingly, when we look at earnings per share CAGR over the last 8 years, you can actually see the Australian grouping has not materially outperformed their global peers. And in the case of SEEK, has actually materially underperformed from an earnings growth perspective despite having a premium multiple. Given our long exposure to these companies, we are hedged by our position in SEEK. Recent operating conditions for SEEK have been favourable, but we see considerable downside for SEEK earnings should economic conditions weaken. Over the past 20 years, the SEEK Job Ad Index has been a leading indication for both emerging employment weakness and strength. With unemployment sitting near record lows, we have begun to see a deterioration in the SEEK Job Ads Index over the past few months. The Job Ads Index reflects the volume of job ads currently listed on the SEEK ANZ platform. As job ad volumes decline, the ability of the business to push through outsized price increases may become challenged, which has the potential to stall revenue growth and create margin pressure for the core operating segment. Additionally, SEEK remains distracted via its offshore and private investments, which we believe are dilutive to the core SEEK Australia and New Zealand business. Having essentially close to flat earnings per share over the last 8 years and trading at 40.7 times earnings, we believe SEEK provides a great offset to both our classified business long positions as well as against broader economic weakness should it present. I'll now hand it back over to Ben.
So in summary, it's been a difficult period for our short book in recent months, which has dragged on short-term performance. Historically, the fund has bounced back strongly post periods of underperformance in our short book. After down years in 2016 and 2020, the fund produced strong returns of over 25% in 2017 and 2021, which were also double-digit positive years for the market. We have added a range of excellent exposures at reasonable prices to our long book in recent months that should do well if the economy stays strong and take share if it weakens. Our short book has consistently performed during periods of market weakness, and we see no reason for it not to work if and when market weakness re-emerges. I'll now hand over to Tim for questions.
Okay, great. We have several questions that have come in here prior and during the webinar. Let's take a moment to look through them. Now, if we don't have time to get through all these, we'll make an effort to get back to you after the webinar. So let's begin. Firstly, there's a bunch of questions here around coal and energy. Firstly, do you think coal stocks will re-rate or continue to trade at depressed multiples? And secondly, what's your general view on the energy sector?
Okay, thanks Tim. Look, we're certainly not forecasting any kind of re-rate in coal stocks, but at current valuations, at spot prices, we don't think it's that a multiple re-rate is required to make money in the sector. Typically, if the underlying commodity price starts to move, stocks will rise and you can get multiple expansion. But I think any sort of sustainable multiple expansion may take time for the broader market to really get to grips with the supply constraints in the sector. We do like met coal. I think medium term that probably has more potential to re-rate than thermal coal, and that's where our exposure is tilted towards.
And on the general view on the energy sector?
Energy sector, the gas price has been particularly weak. We've had some small hedges in Santos and Woodside against that thermal coal exposure. They're more expensive, have more expensive capex programs than the coal stocks. But generally, our view is that the energy sector is not priced for an economic recovery, and that if we did see a recovery, or an acceleration in the global economy from here, energy would probably do well. But the other thing on energy that looks quite interesting to us is this, AI tailwind. There was a stat from one of the US coal producers that US baseload power demand had been growing at about 1% for the last decade, and with the addition or the step up in capex into data centers, it's projected to grow at 2.5% per annum going forward. So I think energy has some nice tailwinds, and we've got some exposure to that through the stocks we mentioned earlier.
Okay. This is always a good one. What is your highest conviction stock on a 5-year outlook?
Okay, that is a question we get every webinar, which I should be prepared for. But I'm going to chicken out a little here and just point to those 4 stocks that Tim referenced in his section that are high quality businesses we've owned, many of them for already more than 5 years. If they continue to grow earnings as they have done, we think we can make really good money on a 5-year view on the likes of CME Group, Amazon, Rightmove, what was the last one?
Visa.
And Visa, absolutely. So look, if you had to push me, Amazon, I think has some very deep moats in terms of their retail e-commerce logistics network, adding on high margin businesses in advertising, and that migration to the cloud looks set to continue at a minimum with this AI boom that's in progress. So high conviction on Amazon, but would be happy to own any of those other names for 5 years.
Okay, great. A question here more focused on the Australian market. It says, we have seen stocks like Spark, Simic, InvoCare, Costa, Link disappear, and likely that CSR, Boral and Adbri are also leaving the ASX. Is the weight of money going into super going to see ASX listed stocks trade at premiums to history going forward?
It's a good question. We're certainly finding that many companies with attractive characteristics in the ASX trade at significant premiums to their comparables in other markets, which is why we've been expanding the long book into classifieds in Europe, looking at the likes of Rightmove rather than owning an REA here. I think the multiples are getting pushed up. How sustainable that is, I can't really guess, but I'm glad we've got the option to invest offshore. That weight of money does have the potential to disconnect share prices from fundamentals in the short term, and we do look at things like index inclusions, which can drive passive money into stocks that may not be that higher quality, and that can provide opportunities on the short book. So look, I wouldn't like to be restricted to the Australian market only for our long investments, because yes, getting good long exposures at reasonable prices here is getting increasingly difficult. I agree.
Okay, got time for a couple more questions. There's a few here on mega cap tech. Firstly, what are your thoughts on how the market is pricing NVIDIA? And secondly, what is your view on US mega cap tech, or the Mag 7 value relative to the broader market? And is Amazon your main exposure in this group?
Okay. So first up, we're generalist investors. We have been invested in the tech sector for a large proportion of the fund's life on the long side, and have made decent money on the shorts. Look, NVIDIA has been in a sector where we felt we hadn't had a really good competitive advantage, because tech hardware and the semiconductor chip supply chain is a very specialist area where we didn't feel like we had any competitive advantage. But looking into it in recent months with the AI boom, as I talked about in my comments, that there are some deep moats for first movers and established players like NVIDIA, like TSMC. The one thing I'll note about the NVIDIA share price move is that it started off a low base. They did have a very difficult 2022, had to write down some inventory, and the share price has largely, there has been some multiple expansion, but there's been explosive earnings growth as well. So unlike other bubbles, there seems to be some real substance behind the NVIDIA business model. What multiple you pay for that, it's difficult to gauge. And the other thing to be cautious on is that their revenue line is driven by the capex of their customers, and they do have a concentrated customer base. So capex, which is capital investment rather than operating expenses, they tend to be more lumpy. So look, we've got a watching brief on NVIDIA and TSMC. If there was ever a hiccup of big enough magnitude, it does have some of the attributes we like. Certainly, we think it's a stage in the AI boom where the theme is maturing, and we want to have a broad exposure to it. But we've chosen to do it in the ones that are perhaps a little bit less crowded so far. So that's the thinking around NVIDIA. On the mega cap Mag 7 relative value to the broader market, I think, like NVIDIA, there are good reasons why people have gravitated towards the Mag 7. They were early to take out cost. The tech sector went into a slowdown really before interest rates started rising, and we've had earnings recover. So you've got recovering top line growth with cost discipline, and they're some of the most obvious beneficiaries of AI with data and products that you can enhance or sell better or target better using AI. So think a lot of the in a more difficult economic environment where consumers are facing some cost of living pressures, I can understand why people have gravitated into the Mag 7. Yes, Amazon is our largest exposure in that space. It is still not back through all-time highs yet. It is, coming off a major capital investment cycle with those high margin businesses growing as a proportion of their revenue base. So I think we've got things like a dividend or share buybacks ahead of us in Amazon, as well as they've still got some runway to fill up that capacity that they overbuilt a couple of years ago without having to spend more money to grow. So really like Amazon in the Mag 7. Tesla, which we sort of put in the too hard basket from a return on brain damage point of view, is the one with the earnings going backwards, and that does, to me, explain a fair bit of the share price underperformance relative to the other Mag 7. So NVIDIA, tip of the spear, probably a little too crowded, a little bit too much good news priced in for us to own it in any size at the moment. Amazon we like, and Alphabet, as I mentioned, is being derated. Earnings are growing, very fast in that business, around concerns around the search business. So I think that's the sort of value play, although it's not completely without risk.
Okay, great. That's all we've got time for today. Thank you everyone for tuning in, and we look forward to catching up with you in the near future.
Okay, see you in 6 months.